Today's regulatory environment, it's virtually impossible to violate rules. And this is something that the public really doesn't understand. And if you read things in the newspaper and you see somebody, violate a rule, you say, well, they're always doing this.
Imagine you have spent 40 years building the perfect lie. Not a small lie. Not the kind you tell to get out of trouble or make yourself sound more interesting at a dinner party. A lie so enormous, so perfectly constructed, so deeply woven into the fabric of Wall Street and the global financial system, that the world's most sophisticated investors, banks, hedge funds, charities, Nobel Prize winners, handed you their life savings without a second thought. For 4 decades, you ran the most trusted investment fund in America. People didn't just invest with you, they begged to invest with you. Getting a meeting with you was considered a privilege. Getting into your fund was like being let into a club that most people would never even know existed. And every single year, without fail, you delivered returns. Steady, consistent, almost impossibly reliable returns. While other funds crashed and burned, yours just kept going. This is the story of Bernie Madoff, former chairman of the NASDAQ stock exchange, celebrated philanthropist, and the architect of the largest financial fraud in human history. For over 40 years, he ran a Ponzi scheme that stole $65 billion from 37,000 victims across 136 countries. He was not a shadowy figure operating from the margins. He was the establishment. He was Wall Street. He was exactly the kind of person you were supposed to trust, and that was his greatest weapon. But every brilliant plan has a fatal flaw, and Bernie Madoff's flaw was hiding inside his scheme from the very first day he built it. He just never thought anyone would ever find it. Bernard Lawrence Madoff was born on April 29, 1938, in Queens, New York. He was not born rich. His parents were not Wall Street royalty. His father, Ralph, worked in plumbing supplies. His mother, Sylvia, briefly ran a brokerage firm from the family home, which was later shut down by regulators for failing to file financial reports. That detail will become relevant later. Bernie was smart. Quietly, observantly smart. He attended Hofstra University in Long Island, where he studied political science before switching to law. But he dropped out of law school after a single year. He had other plans. In 1960, at just 22 years old, he founded Bernard L. Madoff Investment Securities with $5,000 he had saved from working as a lifeguard and installing sprinkler systems. $5,000. That was it. That was the beginning. What followed was, by any measure, a genuinely impressive career. Madoff was a pioneer. He was one of the earliest adopters of electronic trading on Wall Street at a time when the stock exchange still ran on paper and handshakes. His firm helped develop the technology that would eventually become the NASDAQ, the second largest stock exchange in the world. He served as its chairman 3 times. By the 1980s, Bernard L. Madoff Investment Securities was one of the largest market makers on Wall Street, handling up to 5% of trading volume on the New York Stock Exchange on any given day. He had offices on 3 floors of the Lipstick Building in Midtown Manhattan. The legitimate trading operation on the upper floors was genuinely successful, genuinely respected, genuinely profitable. People described him as quiet, measured, precise. He didn't shout or swagger. He didn't need to. He had the kind of authority that didn't ask for a room. It simply owned it when he walked in. He was also extraordinarily generous. He and his wife Ruth gave millions to hospitals, universities, and Jewish charities. He was on the boards of prestigious institutions. He was, to every person who knew him, exactly what he appeared to be, a trusted pillar of American finance. Now, here is how it actually worked. Somewhere in the early 1970s, possibly earlier, investigators were never entirely certain, Bernie Madoff quietly opened a second operation inside his firm. It was run from a separate floor. It had its own staff, and it operated in near total secrecy from the legitimate trading business happening above it. This was his investment advisory business, and it was built entirely on a lie. Here is the lie in its simplest form. When clients gave Madoff money to invest, he did not invest it. He put it in a single bank account at Chase Manhattan, and he used money from new investors to pay returns to existing ones. That's it. That is a Ponzi scheme. It is, structurally, one of the oldest frauds in existence. What made Madoff's version extraordinary was not the mechanics. It was the disguise. He told clients he was using a strategy called split strike conversion, a real, legitimate investment strategy involving stocks and options that sounds complicated enough that most people would nod along without fully understanding it. He chose this strategy specifically because it was plausible. It could explain the consistent returns. It gave investors something to tell their accountants. His reported returns were not spectacular. That was deliberate. Spectacular returns attract scrutiny. Madoff's fund returned roughly 10 to 12% annually, better than the market, but not so much better that it looked impossible. Just reliable. Year after year after year, in bull markets and bear markets, through recessions and booms, that consistency was the real hook, because every other fund in the world went up and down. Madoff's just went up. And wealthy people, it turns out, do not actually want astronomical returns. What they want, what keeps them awake at night, is the fear of losing what they already have. Madoff offered them the one thing no legitimate fund could: certainty. Word spread through precisely the networks that gave it maximum credibility. Country clubs, synagogues, golf courses in Palm Beach, European banks, charitable foundations. Each new investor brought in people they knew, people who trusted them, which meant they trusted Madoff by extension. He never advertised. He never cold called. He was always slightly difficult to get to. That exclusivity made people want in even more. By the time investigators finally caught up with him, clients included banks like Santander and HSBC, hedge funds, the estates of Hollywood executives, charities that had entrusted him with their entire endowments, and thousands of ordinary retirees who had handed him everything they had saved. By the 1990s, Madoff was untouchable. The bull market of that decade was making everyone look like a genius, and Bernie Madoff more than most. His fund was managing billions. His client list read like a directory of the global financial elite. He moved between his penthouse in Manhattan, his estate in Palm Beach, his villa in the south of France, and his yacht with the ease of a man who had never once had to worry about money. He had also, by this point, brought his family into the operation. His brother Peter was the firm's chief compliance officer. His sons Mark and Andrew worked in the legitimate trading business upstairs, and would later insist, credibly, that they knew nothing about what was happening on the 17th floor below them. The fraud had by now taken on a life of its own. It was too big to unwind. Too many clients, too many years of false statements, too many people whose returns would have to be paid. Madoff was no longer running a scam. He was managing an ecosystem, a vast, complex, interconnected web of fake accounts, fabricated trade confirmations, and manufactured statements that his small team on the 17th floor produced manually. Think about that for a moment. In the age of Bloomberg terminals and electronic trading and real-time data, Madoff's team was producing thousands of fake trade confirmations by hand, printing them out, mailing them to clients every single month for decades. And nobody, not a single one of his thousands of clients, not the auditors, not most of the regulators, ever looked closely enough to see it. Bernie Madoff had become, in his own mind and in the minds of the people around him, genuinely beyond suspicion. That belief was the beginning of the end. There was a man named Harry Markopolos, and Bernie Madoff should have been far more afraid of him than he ever was. Markopolos was a financial analyst working for a rival investment firm in Boston. In 1999, 9 years before the collapse, his boss asked him to reverse engineer Madoff's investment strategy to see if they could replicate it. Markopolos sat down with Madoff's numbers, and within 4 hours, he knew something was deeply wrong. The returns were mathematically impossible, not suspicious, not unlikely, impossible. The strategy Madoff claimed to be using, split strike conversion, could not produce the results he was reporting. The options market he claimed to be trading in was not large enough to accommodate the volume his fund would have required. And his returns went up even in months when the entire market went down, which no legitimate strategy could consistently achieve. Markopolos reached a simple conclusion. Bernie Madoff was either front-running, using his knowledge of client orders to trade ahead of them, which is illegal, or he was running a Ponzi scheme. He submitted a detailed complaint to the Securities and Exchange Commission, the SEC, the primary financial regulator in the United States, in May 2000, the SEC did nothing. Markopolos went back to them in 2001. Then again in 2005, with a 21-page document titled, "The World's Largest Hedge Fund is a Fraud." He named Madoff directly. He laid out the mathematics in precise detail. He told them exactly where to look. The SEC investigated, briefly, superficially. They interviewed Madoff. He was calm, authoritative, and convincing. He gave them just enough paperwork to satisfy their questions without ever letting them see the 17th floor. They closed the investigation without taking action. Madoff later said in prison that he had been terrified during those SEC interviews, that he had expected every single time to be caught, but he wasn't, because the people who were supposed to stop him either didn't understand what they were looking at or didn't look hard enough. And so he kept going. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in American history, and it triggered a financial panic that spread across every market in the world within hours. Investors everywhere began doing the same thing, trying to get their money out. For a legitimate fund, this is painful but manageable. For a Ponzi scheme, it is a death sentence. Within weeks of the Lehman collapse, Madoff's clients began submitting redemption requests, asking to withdraw their money. The requests totaled approximately $7 billion. Bernie Madoff had approximately $300 million in the account he used to pay clients. He was $6.7 billion short. And the requests were still coming in. For the first time in 40 years, there was no way to keep the plates spinning. There were not enough new investors to bring in. The markets were too chaotic. The withdrawals were too large. The gap between what he owed and what he had was simply too enormous to bridge. Madoff spent the following weeks in a state of quiet, controlled desperation that the people around him apparently could not read. He continued going to the office. He continued meeting clients. He authorized the payment of approximately $170 million in early bonuses to employees of the legitimate trading business. His lawyers would later argue this was an attempt to protect innocent staff before the inevitable collapse. Then, in the first week of December 2008, he began telling close associates that he had a large sum of money set aside and was thinking of distributing it to certain clients and employees before. And here he paused, before everything fell apart. It was the closest he came to asking for help. Nobody understood what he meant, or if they did, they didn't ask the next question. On the evening of December 9th, 2008, Bernie Madoff told his wife Ruth that he wanted to pay out the remaining money, approximately $200 million, directly to family, friends, and employees before turning himself in. Ruth persuaded him to speak to his sons first. The following morning, Bernie called Mark and Andrew to his apartment. He sat them down, and he told them the truth. The investment advisory business was a fraud. It had always been a fraud. There was no money. There had never been any real investments. It was, in his own words, one big lie. Mark and Andrew Madoff sat in silence for a moment. Then they called a lawyer, and the lawyer told them they had one option. The next morning, December 11th, 2008, Mark and Andrew reported their father to federal authorities. That same day, 2 FBI agents arrived at Madoff's penthouse. One of them asked him, "Is there an innocent explanation for any of this?" Bernie Madoff looked at the agent and said, "No." And here is the fatal flaw. It was not the 2008 financial crisis. The crisis was the trigger, not the cause. The fatal flaw was structural. It was baked into the fraud from the very first day he built it. Bernie Madoff never actually invested a single dollar of his clients' money. That sounds almost too simple for a fraud of this scale. But that was it. 40 years. 37,000 victims, $65 billion in false statements, and the entire thing ran on one single mechanism. He took money in, he paid money out, and he kept the difference. There was no strategy. There were no trades. There was no investment. There was just a bank account and a stack of fake statements. The flaw was not a mistake he made along the way. It was the foundation. And foundations, no matter how much you build on top of them, eventually crack under the weight. The weight arrived in September 2008, and 4 decades of carefully constructed lies collapsed in a single morning conversation in a Manhattan apartment. On December 11th, 2008, federal agents arrested Bernie Madoff at his penthouse apartment on East 64th Street in Manhattan. There were no handcuffs on the street, no perp walk for the cameras. He was arrested quietly, indoors, with a composure that the agents later described as almost unsettling. He did not protest. He did not cry. He did not ask for a lawyer. He had known this moment was coming for 40 years. He had prepared himself for it, in whatever way a man prepares himself for the complete destruction of everything he has built. He was charged initially with securities fraud and released on $10 million bail, secured against his apartment. He was fitted with an electronic ankle monitor and confined to his home. The financial world went into immediate shock. The names of his victims emerged over the following days and weeks like a slow-motion disaster. Elie Wiesel's foundation had lost $15.2 million, effectively its entire endowment. Steven Spielberg's charitable foundation, the charitable foundations of dozens of other public figures, the life savings of thousands of retirees who had trusted their financial advisors when those advisors had in turn trusted Madoff. One investor, a 65-year-old Frenchman named Thierry de la Villehouche, who had invested his own money and his client's money with Madoff, was found dead in his New York office on December 23rd. He had taken his own life. He left a note. It did not name Madoff directly, but it expressed the belief that he was responsible for the losses and that honor demanded he accept the consequences. He was not the last person to die as a result of what Bernie Madoff had done. Mark Madoff, Bernie's son, the one who had reported him to the FBI, hanged himself in his Manhattan apartment on December 11, 2010, exactly 2 years to the day after his father's arrest. He was 46 years old. He left behind 2 young children. There was no trial. Bernie Madoff waived his right to one. On March 12, 2009, he appeared in federal court in Lower Manhattan and pleaded guilty to all 11 charges against him: securities fraud, investment advisor fraud, mail fraud, wire fraud, 3 counts of money laundering, false statements, perjury, making false filings with the SEC, and theft from an employee benefit plan. He stood before the judge and read a prepared statement. He acknowledged his crimes. He said he was deeply sorry and ashamed. He said he had left a legacy of shame on his family. Some of his victims were in the courtroom. Several of them described the statement as inadequate, as performance, as the last act of a man who had spent his entire adult life telling people what they needed to hear. The prosecution asked for the maximum sentence. His lawyers asked for 12 years, citing his age and his cooperation with investigators. On June 29, 2009, Judge Denny Chin sentenced Bernie Madoff to 150 years in federal prison. The maximum possible sentence multiplied across all 11 counts. Judge Chin said the sentence was meant to convey that Madoff's crimes were extraordinarily evil. He noted that not a single letter of support had been submitted on Madoff's behalf, an almost unheard of absence in federal sentencing. Madoff was 61 years old. He would never leave prison. The recovery efforts run by court-appointed trustee Irving Picard eventually recovered approximately $14 billion for victims. More than anyone had initially expected, but still a fraction of what had been lost and distributed unevenly across thousands of claims that took over a decade to fully process. Bernie Madoff spent his final years at the Federal Medical Center in Butner, North Carolina, where he was treated for kidney disease and other conditions. He gave occasional interviews. He expressed remorse. He also, at times, directed bitterness towards the banks he claimed had looked the other way, a position his victims found difficult to accept from a man who had looked them directly in the eye for decades and lied. His wife, Ruth, was not charged with any crime. She surrendered approximately $80 million in assets and was left with $2.5 million under the terms of a settlement with the government. She has largely lived in seclusion since her husband's arrest. His brother Peter pleaded guilty to securities fraud and served 10 years in prison. His son Andrew died of lymphoma in 2014. He was 48. He had spent the last 6 years of his life publicly distancing himself from his father and cooperating with investigators. Bernie Madoff died in federal prison on April 14, 2021. He was 82 years old. He had served 12 years of a 150-year sentence. He died in the same institution where he had lived for most of his final decade, watched over by corrections officers, far from the penthouses and yachts and country clubs that had defined the life he had built on a foundation of lies. Here is what this story is really about. It is not about greed. Greed is too simple an explanation for what Bernie Madoff did. Plenty of greedy people never commit fraud. And Madoff, by the time his scheme had grown beyond any hope of unwinding, was not primarily motivated by greed. He was motivated by something far more powerful and far more dangerous. He was motivated by the inability to admit failure. The prevailing theory among the investigators and psychologists who studied his case is that the fraud did not begin as a grand design. It began as a short-term fix, a bad period, a gap he needed to cover, a moment where he told himself he would make it right when the market turned. And then the market turned, and he could have stopped. But by then, stopping meant admitting what he had done. And admitting what he had done was, to Bernie Madoff, simply unthinkable. So he kept going, and every year it continued. The thing he would eventually have to confess to grew larger. And the larger it grew, the more unthinkable the confession became. And so he kept going for 40 years. The fatal flaw was not that he didn't invest the money. The fatal flaw was that he believed somewhere deep in the architecture of his self-image that he was too important to fail and too smart to be caught. He was half right. Remember where we started. That morning in December 2008, the penthouse, the two sons sitting across from their father, the 40 years of silence about to end in a single conversation. Bernie Madoff had survived SEC investigations. He had survived the dot-com crash. He had survived the skepticism of Harry Markopolos, who had handed regulators a roadmap to the fraud and watched them file it away. He had survived everything that should have stopped him. What he could not survive was time. Because a Ponzi scheme is not a business, it is a clock. And every clock, no matter how beautifully made, eventually runs out. His ran out on a Tuesday morning in December when the financial world finally asked for its money back and discovered there was nothing there. Every criminal on this channel thought they were the exception. Bernie Madoff thought it more than most. He was not the exception. None of them ever are. If this is your first time here, welcome to The Fatal Flaw. Every story on this channel follows the same truth. The smartest criminals always have the same ending. I'll see you in the next one.